All right, Ryan, why don't you kick it off?
Great. So I just, Eric asked me, if I wanted to share anything today, and I wanted to share with the group a leap diagonal call strategy that I've been doing that has been pretty interesting. So I did a presentation with our meetup group a while ago. So really the strategy is just buying long dated options calls that will function as our stock surrogate and then selling calls against them. So goal is, consistent income. And here's just a real high level example on NVIDIA. Stocks trading at 186. It would cost you 18,000 to buy 100 shares. You could buy the December of next year 180 call, which is a 63 delta, for like $4,000. And then you can sell calls against it, weekly calls against it all the way up to December of next year if you wanted to. So you could be making like 113 selling a lower delta, about 2.8% a week in return. And if the stock moves up past your call, you'd make money on your long call. So that's just a real high level example. So the leap is kind of like a synthetic stock. It is and one thing that I would say that you can you can alter this any way you want to. You can, instead of going out a year, you could go out 4 months and up to the next earnings date. You can buy higher or lower delta, and you can sell higher or lower delta. So you can play around with it. It's a pretty cool strategy. Uh, let's see if there's anything else, and then I'll show. So here's the max profit is basically the difference between your short and long strike plus all the total credit you've received. And the same thing with the loss. It's what you paid for that long call less all the credit you received. So that is the 2-minute version of the presentation, but I wanted to show you some results. So these are some trades that I have. The top ones are some leap trades that I've already closed out, and then the ones below in with the yellow are open trades. So, the most I was in any of these trades was 79 days. The highest rate of return was like 24% in 19 days. So pretty nice, returns on them. And the one thing that's pretty interesting about this strategy is if you calculate how many weeks you have to sell calls, you can easily collect more credit than what you paid for the long call. So it's kind of safe in that way that you can keep writing calls against it and make a profit. So that's just, a real high level of the strategy. And then I was going to if
There was one question, Brian. So how do you determine when to exit the entire leap position? So, when would you want to get out of that
yeah,
long call, I guess?
yeah, what I've been doing is if the stock blows through my short call, which I'm trying to sell somewhere like a 15 delta just on as a guideline. If it blows through that call, then my long call has made enough money to, for it to be a real profitable trade. So that's why I would close. A lot of these were closed because of that. So my guideline, if it blows through my short call, I usually close the entire trade out.
And in that case, you would be in a net profit, right? You're saying
Yeah.
because the delta, so when you talk about delta, if you started with a delta 63, I think you mentioned that, and then the short delta is 15.
Right.
As the market moves up, your short delta is going to increase, but so is the long delta.
Right.
So but you would at least want to close the short call anyway, because short call means you would be assigned. So
Right.
unlike a covered call where you could just let the shares be sold, you would actually need to manage it. So then you would decide, okay, do I want to, I don't know, rolling it might be an option, or
Mm-hmm.
as you're saying, just close the whole thing. So,
Yeah. I mean, I think that's a great point, Eric, that in a covered call, like you talked about the other week where your price went over your short call and they just took your shares away. It won't work that way
right.
in this trade. It's two separate trades. Even though they seem to be linked, they're not linked at all. And so
It's just yeah, it's covering you. So talk about the downside to that. If you're in the long call and you have the short call and
Mhm.
you're selling a week or two out, if the stock goes down, that short call is going to make money, but you'll be losing on the long call. So do you just roll that down and just kind of like, is there a downside,
well,
if you will, that you might think about?
yeah, I mean, I would say when I put this trade on, I'm going to say, if it drops 8%, the price of the shares drops 8%, I'm going to be thinking of getting out of the trade. Just like you would on a cover call. You have some level where you say, if it drops below this level, then you should close the trade out. But the good thing about it is if you pick, a stock that's kind of blue chip that will kind of meander around, you're writing enough calls against it to really, you don't have to make money on the long call for the trade to be profitable.
Right. Okay.
So, like for example, the very first one here, I paid $74 for it and closed it for $59, the whole trade. And it still made 12% in 79 days. So the stock price didn't go up. It just, you made enough money selling the call. So that's kind of the beauty of the trade in a way, is that the most you could lose is what you paid for it, less all the credit you collect.
Right. So I'm looking at that list and it's pretty uh diverse in the sense I'm guessing of volatility because I think about Palantir,
Mhm.
that thing's been all over the place.
Yeah.
But then you look at like Caterpillar and maybe even Microsoft. I'm just assuming Caterpillar is kind of a slow mover
It is.
along with JP Morgan, and I'm pretty sure GE is a slow mover. So it looks like you can kind of run the gamut of
You can. I mean,
volatility with these stocks, right?
yeah. What I always like to do, Eric, is I calculate, what's the average I think I could collect every week by selling around a 15 delta. And if that
Okay.
covers the cost of my long call, then I feel pretty confident that the trade will probably work out, especially if it's a good, I wouldn't pick an unknown stock to do this trade on, but like if you said like I want to buy Nvidia, you could buy, a long put, or 250 delta puts would be equal to 100 shares of Nvidia for about a third of the cost.
Right.
So anyway, so
Very
that's
cool.
that's the strategy there. And I am looking at Google, so I'll probably post that in if we put it on today or maybe tomorrow. But something like on a Google, I would probably let me share my trading platform if that's okay.
Sure.
And then I'll relinquish the stuff for you. Okay,
Yeah, no
so
problem.
so Google, what I would do is I would look to go out to December of next year, which is a little bit more than 1 year. But I would probably like something like the 300 call, which is pretty amazing that the 300 call will cost you about $4,300. It's got an open interest of 83,000 contracts for for next December, which is pretty amazing. Might and then you could go out and sell even this week's like a 290, and that would pay you about 159 dollars. So 159 divided by 4290 is about 3.7% return on the cost of your long call. So it's a nice return. And let's see. Then the other thing I always like to do, if I have 410 days left and I divide it by 7, so that's 58 weeks. So if I have 4,300 divided by 58 weeks, if I collect 74 cents a week, I will totally recoup the cost of what I paid for that long call.
Right.
So that's kind of the way I look at it as well.